Okay, perfect. So thank you very much for everybody for attending. I know that we are catching you in the midday, and so I really appreciate you guys being here. And I love sharing different things that I'm doing in real estate, and I'm super pumped about this next step in my journey. And so I was really happy to be able to share that with you guys today. So we have about an hour together, so please grab a pen and paper. We're not going to stop. We're going to just keep going right through. And if you stay until the very end, I will be giving you some gifts. You may not have had access to them before, but they are over $500, worth over $500. And Addie also has a special gift that you can take in person on Thursday if you like. Okay, so the gifts are access to the online video academy, some of the books I've written, and also the private lending document and training that I did last year, where I talk about how I make over $8,000 a month. Okay, that's a month in passive private lending. So that's basically being the bank. So in the chat at some point, I will put in the different links for all of those freebie stuff, and also the training and the private lending documents, so that you can see if that's something that you like to do on your own. Okay, so this presentation is brought to you by the Wealthy Engineer. So during the last couple of presentations, I talked about my journey and how I got to, investing very passively, and how that type of investing has led to infinite return. So I will pass those links on to you. They are on YouTube, and you'll be able to watch those previous sessions. So today I'm going to be sharing with you an extension of the strategies that I've been doing the last few years that I've been getting into. And that strategy is the benefits of buying real estate with a business entity. So Addie at the end of my presentation, so then Addie's going to talk about his car wash and a land purchase that he's working on, so that you can see an example of this. Okay. So if you have any questions, we will have some time at the end. Addie and I will both stay on and address any questions that you have. Also in the registration for this event, there was a couple of questions that we had asked. And so I will be following up with each and every one of you who had some additional questions that you already vetted in there, if we're not able to address it today. Okay, so as I mentioned, we only have an hour, so please, if you can be focused, just imagine, we're going to be talking pretty much high level on a very advanced strategy here. And this strategy could make you, $5,000 a month, $10,000 a month, infinite return with very little work on your part. And so you don't really want to miss that. Okay. So this is a kid-friendly presentation. So if you've got kids in the background, feel free to have them listen in. If my kid wasn't in school right now, he'd be listening in and, be commenting on some of the stuff that I'm saying. So definitely well worth having the kids listen to it. Okay, so during this hour, we're not going to talk about my journey and how I got here. So we're not going to talk about my portfolio, or like how I retired from engineering in my 40s, and all of the different strategies I'm doing. What we're really going to share with you today is the strategy of buying real estate with a business, and how to make that so you can get infinite return. And we're going to talk about how I'm doing it. Okay, so just keep in mind that this is my ideas, so it may not be relevant to you. I'd highly recommend that you do, talk to other investors, talk to your lawyer, financial accountant as well, and just make sure that you get the additional advice before you, do what I do. Okay, so, here's my journey from 1996. That's when I started. So what I'm going to focus on is just the last 2 to 3 years. So basically during the COVID timeframe, I realized that, hey, you know what? I can invest my money with other investors, form a joint venture partnership. They do the majority of the work, if not all of the work, and I'm very passive. Okay. And then once I get my investment back, we still own the property. And so I started looking in around 2020, looking into partnering up with other investors and putting my money in buying multifamilies. Okay. And that's when I realized, oh my God, like I can put in my money and get infinite return forever as long as we have the building. As long as the building's running properly and it's efficient and everything's rented out, I have to do very little work, if nothing at all. So then, you know, during this time, I was sort of looking at opportunities and trying to figure out how I can diversify out of real estate, because everything I have is in real estate. So I looked at stocks, and then I started thinking about businesses. So for the last couple of years, I've been looking at different businesses and figuring out what type of business I can get into, right? So up until this point, like about 2020, 21, 22, I've been looking at multifamilies as well and continuing down that path. And so by the end of 2022, so just a couple of weeks ago, okay, I had invested money into 90 units. Okay, just myself in 1 year. So, which is fantastic, right? And all of which I have a percentage ownership in it. So that's great. So now, while I'm going through buying these units and participating in these joint ventures, I'm like, okay, well, how do I diversify? How do I build long-term wealth? So that's when I started looking at businesses. And prior to that, I was looking at businesses. Like I grew up, you know, like my parents had a variety store. So I always had that in my background. So for the last few years, I was looking at every type of business. You name it, I looked at it. So, you know, bakeries, coffee shops, fried chicken, not my favorite thing to eat, dollar stores, brokerages, Indian restaurants, bubble tea places, like dollar stores, which is my favorite place. So every single type of business imaginable, I looked at, even like Purolator and FedEx. Like I looked at those ones, cleaning companies. Okay, if you can name it, I probably have looked at it in the last couple of years. Okay, but here's the problem with buying these types of businesses is that you don't own the land. Okay, you have to pay rent every single month. You do a triple lease. Okay, and so with that triple lease, if something goes wrong, if the owners sell or if they raise the rent too much, you may have to move your business. And so that for me was a big risk that I didn't want to take. So, you know, still trying to figure out how to diversify and grow my wealth. I thought, you know, let's keep looking at businesses. Well, then that's when it hit me. Oh my God, like, why am I not doing the McDonald's strategy? Okay, so McDonald's is not in the business of making burgers. Okay, they're in the business of real estate. And so I knew this principle years and years ago. And then it hit me like, why am I not thinking like the McDonald's, right? Buy the land with the business. Okay, so Adi's going to come on and talk about a deal that he's working on, which has the land plus the business. Okay, so it's really just an idea to give you an example of what is available out there. Okay, so because I was already on this path of trying to figure out, okay, well, how do I diversify? When Adi came to me and said, hey, Huong, I have this deal. Do you want to look at it? Okay, I was ready to listen. Okay, so now I want to share with you guys what the benefits are of doing real estate with the business. So you're buying both of them together. Okay, so one, you have the security of the land. So one of the things that I mentioned earlier is that if you buy the business and not the land, you're paying rent. Okay, triple lease, and the rent can go up, and usually they do go up. Okay, so the second reason is the benefit is that you don't have to deal with CMHC regulations. Okay, so CMHC is used for multifamilies, so completely different strategy. Okay, so when you buy the business, you don't need to deal with that. Number three, the chances of having a cash call is a lot lower. Okay, it's not that it doesn't exist, it's just that it's a lot lower. So it's a different way of operations, because with a business, you can get credit cards, you can get lines of credits, you have income from that business to keep the maintenance afloat. Okay, fourth is that you start having sales from day one. So if you're buying a business, okay, you're either improving it or inheriting the current sales that it already has. So you should be seeing sales from day one. Okay, and the fifth reason is the potential infinite return on your investment. Okay, so you also get that in this type of strategy. Okay, so I only put 5 here. There's probably more that I haven't even thought about yet. Okay, so as you can see, there are a lot of benefits of buying land with the business. Okay, so Adi is going to share an example. So before we do that, I just want to bring up the legal disclaimer. Okay, so please, this is my idea. This is what I'm doing to grow my wealth. And, you know, before you implement it, please reach out to me. I'm happy to talk to you about what I'm doing. You know, maybe it's not a good fit for you. Okay, definitely talk to your lawyer, financial accountant, advisor, all of those individuals who are part of your team. Okay, so I will stop my share, and Addie, I will let you come on board and bring your stuff on. Oh, Addie, I can't hear you.
Can you see my screen?
Yes, I can see your screen.
Okay. I think before I get into this, I want to answer the question. I think Rain, right? Did I get your name correctly?
Mm-hmm. Yes, sir.
Okay. You're asking what is cash call? Cash call is a situation where you invested in a deal on a project and the project isn't bringing enough money. So you have to go back to your investors to ask them for money, maybe to pay you know, operating expenses or to pay the mortgage. Does that answer your question? So that the money, there isn't enough cash flow coming from the project that you invested in. So let's say you raise $1 million for the project, but there isn't enough at the end. You're operating the business, but it isn't bringing you enough cash flow. So you have to go back to your investors to ask them to invest more money. That's a cash call.
All right, got it.
Yeah. Okay, thank you, everyone. Thank you for being here. I'm just gonna get right into it. Okay, so this is the opportunity we're looking at right now. It's a car wash with a real estate attached to it. Just to add to what Huong was talking about, when you're doing this kind of acquisition or business acquisition, the beauty of it is that it's easier for you to do financing, not just because it has the real estate involved, but because you've got historical financials that you can present to your lender, to the bank, and that will give them a lot of comfort. And you can always increase, you have control over the volume of transactions that you have. Unlike on the multifamily, where if you have 12 units or 100 units, you're capped at that 100 units. And there's a limit to which you can increase your rent. You can't increase your rents, you know, in a way that the tenants can afford, otherwise they're going to move out. So that's part of the beauty of this, that you can increase your volume. You're in control of your volume. So your typical disclaimer is a bit longer because it's securities, and we have to be a bit careful and put all the disclaimers out there. So for us, what we're trying to do is build generational wealth, right? And what we're trying to do with this is to do what we call a roll-up strategy, where we acquire small, medium-sized car wash businesses with the real estate attached to it. And that's what we're trying to do, and we can scale with that. Improve the operations. Once we improve the operations, we increase the value of the property or the business. So we're looking at this current deal in St. Albert, right? We acquired a profitable business that's been in operation for over 10 years now. They've got great revenue, they're in a great location, and we are looking to acquire it. It is self-serve, which means that you go in, you wash your car, you pay a token for using the facility, and you drive off. The upside to this kind of venture or this kind of type of segment of car wash business is that you don't need a lot of employees, because the clients or the customer do the work themselves. So what they pay for is the facility and using the facility, for coming there to use it. So the issue of you having your employee, you know, damage the car, or you have client claiming that your employee damaged their car with a scratch and all that, order has been removed from your operating edict in a way. If I may use that, because you can't, no customer can come and claim that that's the situation, that's what's happening, right? Because they wash their cars themselves. So the problem with what we're trying to address in this market is, I mean, most of us have cars, right? And we bought it maybe 10,000, 20,000, 30,000. And we want to maintain the value, want to maintain the quality of the car. But because of the environment, we need to make the road motorable, because of the climate, because of the weather, especially in winter period, where they have to put salt and other chemicals on the road to make it motorable. That means we need to wash our car regularly if we need to maintain the integrity and the functionality of the car. That means we have to wash it as often as possible. So that's the problem that the car wash industry is addressing, right? So to make sure that there's no damage to your car, you have to wash it often. So this is where we see the opportunity, because we are motivated to wash our car frequently. Because in most cases, we all want to sell our car maybe in 2 years or in 3 years or in 5 years. But for us to be able to sell it and get good value from it, it has to be properly maintained. It has to be in a good condition at the point when you want to wash and when you want to sell it. So that means we have to maintain it properly. So the solution here is CAIA provide the tool for car owners to wash their cars as frequent as possible for a token. So they don't have to incur having to buy equipment, there are laws that against even washing your cars in a certain place in your home. So you are motivated and you don't even want to think about having to do that. You can just drive into a self-serve, wash for less than about 5 minutes, and you're out of there and your car is clean and you maintain the undercarriage is fine. The paint is not wearing off, it's looking sharp and everything is clean. So that's the solution with this kind of operation of a self-serve car wash. So for the industry, if you're in the Canadian industry, for instance, the self-serve currently has about 23% of the industry, right? So which means, and it's growing over time, because it's not that expensive compared to when you're doing full detailing, where you probably have to pay about $15 or $20, depending on the level of work that needs to be done. People want to be able to go into a car wash, wash their car, $5, $7, and they're good, they're gone, right? And if you, in terms of the market we're looking at, focusing right now on our barter market, and you can see currently the market is about 21%. Right? That's the market share of barter right now. And in terms of the profit contribution in that is 21%, and currently has about 715 enterprises or establishment or car washes right now. The major player in the Canadian market only controls 7.3%, which means a very fragmented market. What it means by fragmented is that everybody more or less have a car wash, but you have some that have just 1 bay, have 2 bays, 3 bays, 4 bays, some are not automatic, some are self-serve, some are not self-serve. So, but you have proliferation of car washes here and there. So there's an opportunity to actually do what we're talking about in terms of the roll-up, to buy as many of these small, medium-sized car washes and consolidate them. So we think there's huge opportunity in this $1.2 billion market.
So I have a question here, Adi. The product and service segment where you have that the breakdown, is that just for Alberta, or is that all across Canada?
No, that's across Canada.
That's across Canada, okay.
Yeah.
Quick question, is the business seasonal?
Yes, it is seasonal. So during winter, you tend to have a lot of washes because of the salt and chemicals on the road. It goes down a bit during the summertime, where the road is relatively dry. So it is seasonal. Car wash business is seasonal. Does that answer your question?
Okay, I'm basing it off of my drive-bys, the one that are close to my house. I think it's less busy during the winter, but maybe I'm wrong, maybe it's just my timing.
That people don't wash during the winter?
They wash, but they reduce the use of self-serve because of the cold. So are the,
Yeah, so it now depends on the type of self-serve. What we're looking at right now is the covered self-serve. Those ones that you're talking about, the open ones where you have to, I mean, I have one very close to my house. There's a roof, but everywhere is open. So because of that code, maybe the number of people going there to wash reduces. But what we're looking at is it has a facility that is covered. So you can go in, drive in, and the door is shut after you. Once you drive in, you can wash your car. You're not washing in the cold.
okay, thanks.
So in the current market, the market opportunity right now. So in the car wash industry itself, when you're looking at targeting to buy a car wash or to build a car wash, the population density that typically look at is 16 to 65 years old density, right? You have to look at least 35% of that population density has to be between the age of 16 and 65. And what that means is that that's the age range of people that you find on the road that driving frequently. So in the market we're looking at right now, St. Albert, 49% are within the age of that 20 and 60 years old that are on the road driving. So there's actually good density in terms of population density of the target clientele. So, and the income in that same industry should be about, it's usually about 45% to 45,000 to 75,000. But in the market we're looking at right now, predominantly you have people that's earning between 60,000 to 150,000, and that constitutes 81% of that household income. So that means people can actually afford to go and wash their car as frequently as they want. And the mode of transportation in St. Albert, over 92% drivers and passengers vehicles. That what that means is that people is car dependent environment. About 2% is public mode of transportation is public transit, just 2%. So that means whatever you want to do, every errand you want to run, probably have to drive in most cases. So if you have to drive, that means your car gets dirty as often as possible because you're constantly using the car. And for you to maintain the car, you've got to wash it as frequently as possible. So if you look at in terms of the work score, it's about 30 out of 100. It means that a lot of restaurants, a lot of jobs are not close to where people live. So they have to do a lot of driving around. And the business for a self-serve, the business model is quite simple, right? Is the function of the drive-by traffic and the volume of that you can capture. And how do you capture that? Fine, by having a nice signage that people can easily relate with, is close to people, is very convenient when they're driving, and it's on a road where the speed limit is about 50 kilometers per hour or less, right? You can, because people are slowing down, so they are not on the speed, they can easily just drive into your car wash and wash their car. So it's the volume of that you can capture. That's because your number of sales. Then you multiply that with price per charge for the use of that, for your use of your facility. So as a self-serve, if you choose to spend 10 minutes there, you pay for 10 minutes. If you choose to spend 5 minutes, you pay for 5 minutes, right? So it's a function of how many minutes you spend. That's what you pay for. Where we are right now in terms of our targets, we've got 3 indirect competitors. I mean, indirect in the sense they're doing food detailing. That's not what we're doing. That's not the target that we're looking at. We're into self-serve. We only have one direct competitor that does self-serve across us. And the funny thing about this competitors and even the target is they don't even have any form of publicity or advertising. All they depend on is just the signage outside. So there's no social media presence, there's no website. And so without social media presence, without website, they can't even have membership, right? Like you signing up like a subscription agreement you have with Netflix or Prime or whatever. So you could actually have that to build to stand out from your competitors. So all of them right now within the market we're looking at within that location don't have that. Even those that are doing food detailing, they don't have website to drive traffic to their establishments. So that's part of what we plan to implement, to have a cash and card payment systems, membership, and have a more displayed LED display, menu display where people know exactly they're not squinting their eyes to see what they're doing or how the system functions. Okay, they need a wash, they need soaking, they need pre-soaking, and they can easily see that. So to add to what I just talked about, this is a growth strategy in terms of how we plan to grow the business. Even without all this strategy in place, the business currently has been generating over 400,000 in revenue. Yeah, with those, apart from, during the COVID era. So apart from all this, they have about 400,000 in revenue, and they are netting about 20% in terms of profit margin. So to increase that value, these are the things that we look at in terms of the growth strategy. We more have social media presence, have websites, be able to book online. That's part of what we're trying to implement, and have multiple payment systems, not just a coin-based system that operates right now. So historically, this is what it's been. So it was only during the COVID 2020 where the COVID, we were all staying at home, we didn't go out. The revenue was about 300,000. And 2021, when things started improving, went close to 400, which has been generating historically. By 2022, it's gotten to, this is 2022, August, it's gotten back to where it used to be, which is over 400,000 in revenue. And if you look at the profit margin, it's been consistent. So you have 29% profit margin. So this is what we've done in terms of projection. Even though it's gone back to where it used to be, about 5% in terms of growth year on year, what we projected is to be on a very conservative track. We've used 3%. And this 3%, we're just basing it on how the business is being operated right now. We've not factored in the growth strategy. So we want to just be conservative and see how the numbers, what would number be like? And this is where we end up at. So we get a 13% profit margin. This after paying down everything. What we have in 2023, we still have 56,000 in terms of net profits. Net cash flow. See, what that means is that after paying everything, paying down the mortgage, paying down the interest, operating expenses, what is the cash flow that is left in this business that can be distributed to the investors? And we've been a bit aggressive in terms of our operating expenses as well. If you look at other expenses, we are growing at 5% from year 2023. And the property tax is a function. What we've done is to use as a function of the revenue at 7% year on year. And we grow the payroll by about 4% year on year as well. And the number still makes a lot of sense for us. So what's the need for investors in this case? Investors have interest in multi-million-dollar real assets, at a fraction of the cost. You have the investors are not provide a personal guarantee or signing on to the mortgage. They are free and clear of that. That's the responsibility of the sponsor and the GP. You don't get involved in the due diligence, the acquisition process, and all that. But they enjoy quarterly distribution, which from this deal will happen from the 3 months after closing. So we want to be able to be paying the quarterly cash distribution from 3 months after closing. So it'll be a quarterly distribution that we look to have. And to add to what On said earlier about reserve and cash call. So from onset, we are going to have reserve build up, and we're going to have building on that reserve. So there won't be any negative cash call. And we're going to have line of credits because it's a cash flowing business and cash comes in every day. So we could easily get line of credit with that. So we will not be having any negative cash calls from the investor. Okay. This is just a team. So the funding, so we're doing a 70-30 in terms of a source of funding, or the funding, how we want to do the funding of this deal. And that's the use of funds that would, so you can see the reserve to, we're building 40,000, just going in, have a 40,000 in reserve, and we're going to be building on that. Of course, we'll be utilizing it as well to make more, to generate more return, but we're going to have that reserve that we can call on at any point if unforeseen events happen that we needed cash to take care of. And in terms of exit strategy, what we look at, I think I didn't include the fourth one here. The first one is to do a refi. We refinance the transaction. We take out some money back to our investors, or all of their money, or we do an outright sale. When you do an outright sale, that means we sell the business. The way we are buying it today, buying the business and the real estate, and we sell it to a third party. Or if we have a situation where some of the investors say, okay, I want to exit in year 5, which is the old period you promised that you want to hold this deal, we want to exit. And majority of the investors say, okay, since we're enjoying good cash flow from this deal, it makes no sense to exit. So those investors that do not want to exit will more or less buy out the person or the partners that want to exit, depending on if those that want to hold on to the deal are in the majority, right? So at that point, we do the valuation. What would it have been if we had sold this deal outright? Based on your proportion, based on your pro rata interest in this deal, this is how much you're going to get. So after giving you back all your invested capital, this is the profit that you would have made, and we'll pay out that particular or those particular partners that want to exit. And the fourth one is what we can do is to do sale and lease back. So we sell the real estate part of the business, right? Then we lease it back. We can sell it within the group and lease it back. So by doing that sale, we can take some money out and give to the investors, but they'll still continue to enjoy cash flow coming from the deal because we've not exited the deal. We just sold part of the asset of the deal.
Right, and so with that exit strategy that Addie's talking about, that's very common for laundromats, right? So a couple of years ago, I did a talk with a gentleman from the US, and that was their strategy. They would buy the real estate land with commercial lots on it. They would get the laundromat up and running and then sell off the laundromat to somebody else, but they would still keep the land.
Yeah. So this is where we structure the offering that we're presenting right now. Is we have 2 options. People that would like to come in as an equity partner on this deal, or what we call limited partners, or those that just want to have a particular return year on year. So we call this a preferred equity. So they earn 10% each year, and if they decide to live on their 10% by the end of the year, so that means it get compounded. So this 10%, for instance, if you invested 100,000, at the end of the year, you decide, okay, I just leave my 10,000 in the transaction. I don't need it, just hold on to it. So the next 10% is going to be based on 110. It's no longer just 100 because your investment in the deal has increased by 10,000. So that's what compounding means. But this will be on annual basis. But for this preferred equity option, is going to be between 3 to 5 years. I mean, 2 to 3 years, that's what we're looking at. But on the option A, which is the equity partners, we're targeting to return to investors on the average 2%, 2x multiple. The profit share is going to be 70%. So whatever profit that we are making, the investors are going to have 70% of that profit, and the GP is going to hold on to 30%. Based on the numbers that we ran already, we have cash on cash return of over 6%, but we just want to be very conservative and just target 5 to 7%. But if you look at the next line, you see that on cash, even year one, with those very conservative numbers that we projected with, we have about 9% on the average for the 5-year-old period. So how do you come into this deal? So minimum investment is 100,000. This is something that is of interest, immediate commitment to show that, okay, you want to save a spot, you're interested, is going to be 10%. Then we are going to have a follow-on commitment of another 10% by January 25th. And by February 20th, there will be balance of funds of your commitment. So the next step now will be to just complete NDA and expression of interest form. We get you the commitment, soft commitment letter, which you're going to fill in, put in the amount that you're interested in, and the amount you're committing to the deal, and proceed to the 10% soft commitment deposit. You get access to the data room to look at all the documents. And you have your subscription agreement. We have the limited partnership agreement, and we have the management agreement in there as well. The underwriting that we've done on this deal, the documents that we signed with the sale and purchase agreement, for instance, you can have access to all these documents. And so once we close, you'll be having, apart from the quarterly cash flow, there will be quarterly reports to tell you where the situation of the business, how profitable it is on the quarterly basis, and tell you where things are at and how we are improving the value of the asset. Thank you. I think that's about it.
Okay, so I'm going to bring up a poll, and I'm sorry, I should have brought this up at the beginning, so I'll bring it up now. So if you could there's only 3 questions, so if you could answer it, that would be fantastic. This is actually part of my due diligence and trying to learn more about the car wash industry and the habits that people have around car washing. Okay, so if you could take the time to answer that, that'd be fantastic. The other thing that I wanted to mention is that Ryan, you asked a really good question about, do you need to be an accredited investor, right? So you can partake in deals like this from many different ways, right? You can do what Addie's doing and be the working partner, okay? You could come in with the money, and usually in that case, you would need to be accredited, okay? Or you could be part of the family exemption. So if you have family that is doing real estate or doing deals like this, then you could participate in their deals without being an accredited investor. Okay, so there's a bunch of different ways to get in. The piece of advice that I would always say is that even if it's family, you still do want to do your own due diligence on it. Make sure it's an opportunity that fits for you.
Yeah.
Okay.
Yeah, and at the same time, if you have relationship with the sponsor of the transaction, you could qualify under the exemptions to do this kind of deals. But that relationship, you need to be able to establish how you have that relationship, how long you've had that relationship. Is it over a year, just 2 months? If it's 2 months, it's not enough. You don't know, you can't claim to know that person in 2 months. So maybe you build a relationship for over a year, more than that, yeah, that you might qualify to join to be in a transaction like this on the basis of that exemption of having a relationship with the sponsor.
Okay. Yeah. All right.
Sorry, I might have missed it if you said it. For the profit, how is that calculated? Is it only operating revenue, or does it include the appreciation in the land value? How do you compute the profit that you distribute?
It's on everything altogether. It's cash flow from the operations. So on a quarter by quarter basis, that will be cash flow from the operation. If we decide to sell the property or sell the assets with the business, that will be based on whatever profit we've made after selling, selling the property and the business and paying down the mortgage, returning investors' money back to them. Whatever profit is left at that point as well will be 70%.
Mm-hmm. Yeah, so usually with a real estate deal, one of the principles that I try to follow is when I'm buying real estate, I want to go camping. And camping stands for, okay, cash flow, appreciation, mortgage pay down, increasing net worth for generations. Okay, so you want to make sure that you can get all of those things, if not the majority of those, right? And so when you're buying the land and the business, you are getting the cash flow, the appreciation if there is, and then the pay down on the business loan or the mortgage on the land. Okay, so yeah. Great.
And at the same time, that's factored into when you do an exit, because you pay down the mortgage. So that build on that Huong was talking about right now, the equity build up, because you're paying down the mortgage, you have that, indirectly have that build up. So by the time you're exiting, you say you take 1 million mortgage, by the time you're exiting, maybe you pay down 200,000. That's equity build up already. So when you're selling the asset, you sold the asset, you pay down, you're going to pay down 800,000 instead of 1 million. So that 200,000 difference is the equity build up. That will be part of it.
Okay, so I'm going to close the poll. Okay, so there's 2 people still waiting for some replies too, so I will leave the poll open for another minute. If you're one of the 2 people who did not reply, please participate in the poll. It's really just for our knowledge. Okay, it's like we're not going to be using it for anything outside of that. So please, if you can reply to that, that would be fantastic. And then what I'm going to bring up is just the slide about the benefits, and then that way you guys can see that. And that way, if you guys have any questions around that, you guys can ask about that, okay? Because really what I'm hoping is to pass on some of the education and the knowledge that I've acquired over the last couple of years when it comes to growing my real estate portfolio, diversifying, and continuing to grow my wealth. And so one of that is looking now at businesses with land. Okay, so these are the benefits. Yeah.
Can I quickly say something?
Yeah, go for it.
Yeah, so I'm in Edmonton tomorrow to Friday. If anybody is interested, we are having a walkthrough of this target on Thursday by 10 a.m. MT. So if anybody is interested, please reach out and I'll be there.
Yes, good thing you remember that. I totally forgot about that. Yes, so Adi is doing the part of the due diligence walk on Thursday. And if you're interested in learning how to do a due diligence, okay, for a car wash and a business and land, okay, then it's free to meet up with Adi and do that walkthrough. Like there's so much education around doing a physical walkthrough. I highly recommend it if you've got time during the day when Adi's doing this. What time are you doing it, Adi?
By 10 a.m. MT on Thursday.
So you're doing the walk. You're starting the walkthrough at 10 a.m.
Yes,
okay.
I started by 10 a.m.
Okay, so if you're interested in meeting up with Adi to do the walkthrough, email or text him and sort all that out. Okay, is there any other questions or comments about the strategy overall of buying land with a business? Okay, because we're doing really good for time.
I had a question. I had a
Yeah, go for
question regarding, so you've given some numbers at the beginning. What
Yeah.
considerations are given for like interest rates and inflation? And how would inflation affect a deal like this?
Great question. So to answer the first one relating to interest rates, based on our projection right now, we've actually used 8.5% in terms of our projection. Even though based on discussion we have with mortgage brokers, we're going to get less than that, but that's what we projected with, and the number still works. And while if the 3%, remember we factored a growth of 3% instead of the historical, right? 3% is trying to factor in the market in terms of inflation. And even with the inflation, we've not factored in the growth strategy that we plan to implement. Because these are how the big institutions, especially in the US, have maximized the opportunity in the car wash space, like having a website, like having people that book online, like having membership. You know, with membership, more or less, you're locked in for that month. So what are you? And it's called what is called unlimited wash. So the fact that you have unlimited wash does not mean that you're probably going to be washing your car every day. So people will still fall back to the way they used to wash their car, but for a month, you know that you're going to get this $20 or $25 from this particular for the particular client. So we factor in all that in terms of inflation based on our projection, how we think the revenue is going to grow. And at the same time, the interest rate, we use a very aggressive number in terms of the rate to build a model and see if the numbers still work.
Okay, thank you.
Does that address your question?
Yes, it does. And just one other quick question regarding the multiples. Where did you get the multiples from? And
the multiples that we target to return to investors?
Yes, and how conservative are they?
Okay, so the multiple is a function of I haven't paid everything, I haven't paid out all the expenses and paying down the mortgage and paying off the mortgage. What's the profit that is left, right? So all the cash flow that you receive, you divide it by how much investors put in. So in this case, so what this means is that all the profit is over that would be 1.3 million. So you divide that by how much was put in, which is about 660,000. That gives you the multiple. So that's how we arrive at that multiple. That's how you calculate equity multiple.
Okay, thank you.
So it's a function of how much cash flow, and it's a cash flow, it's not profit, it's cash flow, right? And when you're doing limited partnership structure, you only have one tax bracket. So unlike a corporation where you have two tax brackets, you have one on the corporate income tax, then when you get the money as well, you get taxes in terms of dividend. But in a limited partnership structure, that's not the case. You only get taxed once. At the corporate level, there's no tax. You only get taxed on what you receive as an investor, individuals that get taxed. And the way this is structured, especially with a good accountant, the money that you receive year on year is not what is taxed as an investment. So that quarterly return is not what's supposed to be taxed. It is what you gain after you, let's say you put in 100,000. It's anything above that 100,000 that get taxed. So the money until you recover all your money, you don't get taxed. So you can always, you can talk to your accountant and ask all this question, talk to your advisors for them to clarify what I just talked about.
Okay, understood. You're taxed on everything above what you initially put in. Got it.
Yeah, and that's how limited partnership structure works. If you work with a good accountant, not all accountants. Not all accountants.
Yeah. So actually, one of the questions that came up from our preliminary sign up was, how passive is buying land plus a business really is, like in terms of all the different real estate strategies there are, right? So from my point of view as an investor, if I'm coming in from the side of a money partner, it should be very passive. Like you do your original due diligence to make sure that this deal is right for you. You contact your lawyers, talk to the accountants and all that stuff, right? And then that at the beginning should be the bulk of the work that you do. And that should be your involvement. Going forward or continuing afterwards, you should be silent, right? And you may be getting reports every quarter, semi-annually, so it depends on the setup. So then your involvement at that point is really looking at the reports, understanding the content, and then at the end of the year, reporting out to your accountant, right? And then maybe in a few years, deciding, okay, do I want to continue in this or do I want to pull my money out and do something else, right? So if you're coming from the side of the person putting money in, it should be very passive, right? Now, I know some real estate deals that have gone bad. Some of the passive investors have stepped up and said, okay, now you know what? Those individuals are no longer part of the deal. So then now we're going to take over, right? And then because it's in their interest to make sure that deal works, right? So those are very different cases, right? So now if you're looking at, like, say, a multifamily to a land with business, it's a different strategy, right? Because you're not dealing with tenants and the landlord tenant board, like you're not dealing with those things. A business to a multifamily is a completely different strategy.
Yeah.
Okay. So with the business side, if you're coming in from the money side, it should be very passive as well. Now you could be on the working side, which is what Addie's doing. That working side is very active. Like you are actively making sure that all the T's are crossed, all the I's are dotted. Like you're working with the lawyers, accountants, like contractors, right? And then you're doing presentations like this to teach people about the strategy and making sure that it's right for them, right? So it's very active. And then you're maintaining the communication every month with people that you're working with, right? So it's very, very active. Okay. So two different areas, just so that you know what side, one side is very, very active and one side is very, very passive. Okay.
All right then. Hello, everyone. Hello, Ade.
Hi, Yemi.
Okay, and hello, Huong. Nice to meet you here virtually. I have a few questions, but I think I'll just take one or two. I think the first one is regarding the net asset value of the current business. Like what exactly is the asset base? I noticed the land value. So rough figure, it's about 700 square meters, right? Isn't it?
800.
No, you said 800 square foot. So that's about 700 square meters.
Okay, meter. Okay, yeah.
Yeah. Rough and dirty. So I mean, I'm just wondering, so what's the value of that? Like, I'm interested in the current net asset value of the business, and then what's driving the acquisition price? Like, is it being bought at a discount or is there a premium being paid? Yeah, so those are the preliminary questions I have for now. Yeah. Okay, can you hear me?
Yeah, I can hear you, Addie. I think you're frozen.
All right then. And he's muted, I think.
Oh no. Yeah, he's frozen there. Let's see. Okay. Give him a second. And then, so if Addie doesn't come back on, we will send him this recording and he can reach out to you with that answer.
All right, no problem. That's fine. I can.
Okay.
Oh, okay.
Oh yeah, no, I think he got booted out.
You'll probably rejoin. Yeah.
Okay, yeah, so then we'll probably get you to re-ask
All
that
right.
question.
No worries. That's fine. Yeah.
Okay. Okay, all right. While he's logging back in, are there any questions about the overall strategy in terms of buying a land with a business? Okay, can I ask, is there anybody else who's looking at a business that they think may be worthwhile looking at? Okay. Last month, I was told about a Korean croissant company that was coming to Canada. So there's so many opportunities out there. All right, Addie, can you, let's see here. There you go. Okay.
My internet, I don't know what happened.
That's all right. Okay. Yemi, do you want to ask your question again?
She was talking about the land value.
Yes. Okay, so you got it. Okay, perfect.
Yeah. So the land value right now, I know it's about $1 million plus, but what we've done is to actually commission an appraisal to confirm, from a third party to actually do that. So that's will be confirmed by the end of the week to say, okay, this is actually what the prevailing market value of the land is. Does that answer your question, Yemi?
Part of it.
Okay.
Yeah.
Go on, please.
Probably, maybe I'll just send you a list of initial questions I have, and then we can take it. Yeah. Because I noticed we only have 3 minutes to go. Yeah. I'll just send you a list of the questions I have, and then we'll take it from there.
Yeah, that's fine.
All right then.
You have my WhatsApp, you have my email.
Okay, splendid. Yeah.
Okay. All right, so as Yemi mentioned, we've got about 3 minutes left. So I just wanted to say thank you, everybody, for attending. I love educating and teaching and sharing what I'm doing with everybody. So I'm really happy that you gave me your day, or your I don't even know where half of you guys are. So I'm really happy that you gave me a bit of your time today to be able to share with you this stuff. If you have any questions, please feel free to reach out to Addie or myself. Always happy to help everybody along so that we can all make generational wealth. Okay. Thank you again, everybody. Have a great day.
Thank you so much. Thank you for being here. Cheers.
Bye, everybody.